We will begin Chapter 3 by covering the basics of accrual accounting. First, let's talk about the time period assumption. This is when an organization's activities can be divided into specific time periods. Some examples are monthly, quarterly, semi-annual, or annual. The most popular reporting period is annual, followed by quarterly reports. A company's reporting period can be on a calendar year, which is from January 1st to December 31st. A company can choose a fiscal year instead of a calendar year. A fiscal year does not need to begin on January 1st, but can begin on the first day of any month and end the last day of the month that is 1 year away. For example, at Ocean County College, they do not follow a calendar year. Instead, their year starts July 1st and ends on June 30th of the following year. They do this for a few reasons. One is that they are not as busy in the summer as they are in January. This helps the accounting department prepare for the annual audit. Secondly, it follows the student's normal path where they start in the fall semester and end the year during the spring semester. An interim time period is a time period shorter than a full year. This could be a monthly or quarterly time period. Ocean County College provides data not only on an annual basis, but also by semester. Public companies are required to disclose quarterly financial statements as well as their annual reports. The word interim is similar to the word intermediate, meaning it's in the middle or not full. Think of intermediate school. This word association might help you remember what it means. Next, I will cover the differences between the accrual and cash basis of accounting. The accrual basis of accounting is recognizing revenues when they are earned, not when the business receives money. Whether a customer pays in advance or pays at a later date, it is only considered revenue when the business provides a service or a product. On the other hand, expenses are recognized when incurred, meaning that whether I pay my bills in advance or late, I will put the expense on my books when I used it, regardless of when I pay it. This is what we have been doing this semester so far. Now, the cash basis of accounting is when revenues are recorded when cash is received and expenses are recorded when cash is paid. This method is not GAAP, while the accrual basis is GAAP. The cash basis is used primarily by smaller, non-public businesses. Larger corporations that are publicly traded on the stock market have to follow GAAP guidelines of using the accrual basis, while non-public companies do not. If you start your own little business selling trinkets online, you will most likely use the cash basis. However, since it is not GAAP, we will be learning the accrual basis throughout this course. A way to remember what the accrual basis is to recognize revenues and expenses when the event or action happens, and ignore when the cash was received or paid. Two principles that we learned in Chapter 1 relate to this chapter. First is the revenue recognition principle, which requires revenues to be recorded when goods or services are provided to customers and at an amount expected to be received from customers. The second is the expense recognition principle, also known as the matching principle. This is when expenses are recorded in the same accounting period as the revenues that are earned as a result of those expenses. For example, if we made a large sale in 2020, the expenses related to making that sale, such as purchasing inventory, would also be recorded in 2020 and not in 2019. These principles go hand in hand with the accrual basis of accounting. This slide is pretty important to pay attention to because it will show us an overview of all the adjusting entries that we will be learning next. I will only briefly explain each one because we will be going over each one individually over the next few videos. There are two types, accruals and deferrals. We will take a look at the accruals first. There are two types of accruals. The first one is accrued revenues. This is revenues for services performed but not yet received in cash or recorded. This means we provided the service or product to the customer, but they have not paid us yet. The second accrual is accrued expenses. These are expenses incurred but not yet paid in cash or recorded. This means we used an expense, such as your electricity this month, but will not be paying cash until a later date, maybe a few weeks after the month ends. My hint for accruals is actions first, dollars later. The A for accruals matches the A in actions. A for accruals, A for actions first. We do the action first, which is making a sale or using an expense. And then the dollars come later. Whether we are receiving cash or paying cash, it will be done at a later date. Now we will look at the deferrals. There are also two types of deferrals, and they are similar to the accruals, but are opposite. Instead of the action first, the dollars will be first. The first deferral is unearned revenues. This is when cash is received before services are performed. It is similar to getting a cash advance. At the tax firm I work at, some customers will pay to get their taxes done before we even start the work. The second type of deferral is prepaid expenses. This is going to be the more difficult one to learn because there are a few different journal entries to learn for this one. A prepaid expense is when expenses are paid in cash before they are used. This would be like paying your next month's rent at the end of this month. You are paying for the expense before using it. One important area that we will learn regarding prepaid expenses is depreciation. I will go over this in detail later, but I will give you a quick introduction to depreciation for now. When we buy an asset like a piece of equipment, we put it on our books as an asset. However, it is still a business expense. We will expense the cost of the asset over its useful life by depreciating it. It is a prepaid expense because first we purchase it and then we use it later over many years. My way to remember deferrals is dollars first, actions later. A D for deferrals and a D for dollars. We are receiving cash first for revenues or paying cash first for expenses. And the action part comes later